Welcome to the Ag Commodity Corner Plus podcast. It is October 17th, 2025, week 30.
Hey, everybody.
Welcome. Don't forget to subscribe, to like the channel so you can get notified when the next podcast is out. It's every Friday around that 4 or 5 o'clock in the afternoon. Sometimes we have technical difficulties. Our title this week is Markets Continue to Chase Chinese Trade Headlines. Let's get right into it with our summary weekly market quote chart. And we didn't have a lot of new lows or record new highs, except for gold and silver, which outshined everything else. Sorry for the pun, but there were some notable moves like corn and beans that held the supports and bounced. Canola also bounced on some headline news. We'll get into that. CME lean hogs continued their slide lower, hitting support at 82.250. So hopefully we can bounce off of that into next week. Live and feeder cattle futures broke to new record highs despite the lower weekly close on some headline news. Bitcoin did not act very well in a risk-off week. We mentioned this in past podcasts that we felt it was probably overdone to the top side and we needed some sort of correction. We'll get into that. Crude oil also continued its slide lower. And, of course, gold and silver continued to outshine because of the safe haven play. They both hit new record highs. It was amazing. I've never seen gold trade 249 points in 1 week. So that's pretty impressive. All right, so let's get into the presentation. Let's start off with this escalation in the U.S.-China trade war.
Well, Mo, that tit-for-tat trade tariff saga between the U.S. and China continues in its latest installation. On October the 10th, U.S. President Donald Trump threatened to impose an additional 100% tariff on Chinese goods in response to China's curbs on exports of rare earth minerals, effective from November the 1st.
I think Trump just misunderstood what China was doing. The messaging has to change. The optics look bad. We don't need a play-by-play. Just get the darn deal done. We're tired of this. Anyways, we hope at the end of the month, maybe we don't get a breakthrough in the trade deal, but maybe we still get some soybean purchases, some goodwill purchases. So we're hoping for that at least.
Sticking with trade war headlines, Trump has warned China that the U.S. could cut off purchases of cooking oil. Trump on Tuesday said the U.S. was prepared to retaliate to China's refusal to buy U.S. soybeans. As we know, China has been the biggest buyer of U.S. soybeans, but for this year, exports are virtually zero to China. And China has shifted to Argentina and Brazil for their soybean needs.
You can see from this chart that the amount of soybeans that we ship to China versus the amount of cooking oil the U.S. imports from China is very small in comparison. So this is very small in the grand scheme of things. And remember, U.S. Congress passed in July that they were no longer going to allow U.S. Chinese cooking oil to be part of the U.S. biodiesel plan in 2026. That cooking oil needed to come from either or made in the U.S., Mexico, or Canada in order to get that tax credit. So Trump could threaten, he can ban, put an embargo on cooking oil. I don't think it would make a difference, to be honest with you.
Sticking with soybeans, domestic crush in the U.S. makes up about 60% of U.S. soybean usage, while exports to China account for about 20%. Despite this week's record U.S. soybean crush pace, which has been continuing, it is yet unlikely to fill the gap that Chinese exports would leave. For September alone, no per U.S. crush came in at 197.86 million bushels, higher than what trade estimated, 11.6% higher year on year, and the fourth largest on record.
USDA has already increased crush demand for 25-26 versus last year by about 35 million. If we can get clarity on 45Z and move along with this new domestic soybean oil source, we could maybe see that crush expand by 70 to 100 million in a best case scenario. But remember, China buys about 337 to 400 million bushels of U.S. beans. And even though crush is record strong, I don't think it can fill that gap. It's just like the rest of the world. They are buying some more soybeans from the United States, but to fill that gap is going to be quite difficult. And this chart just shows you the difference between the amount of soybeans we're exporting versus crush. Now, I think that gap narrows in 26, but it's still going to take a very long time.
Looking at soybean technicals, soybeans, the November contract has been trading within a range of 9.75 and 10.75. It's still holding above $10. Resistance comes in at 10.32, followed by 10.56, and then 10.78. But the bigger deal is the lack of USDA data, which just keeps all of us in the dark as far as trading is concerned.
Yeah, but after this week's noise and headline news on trade tensions, this was a win. The fact that we were able to hold a support at $10 was good news. And I think the key difference between 2025 and 2018 that a lot of people don't talk about is that if you go back to 2018 when we hit $8, ending stocks were over 900 million versus this year at 300 million. So I think that's one key reason why we haven't fallen off the cliff.
Sticking with soybeans, U.S. soybeans are about 90 cents to $1.50 cheaper versus Brazilian soybeans in the global export markets. But the trade war has sent the biggest buyer, China, to Brazil more, and China is supposedly dipping into their local reserves as of now and not buying U.S. soybeans. Their local reserves are said to be about 6 million metric tons, and they seem to be waiting for the new Brazilian crop to come online next year.
I don't think China can wait, but they're using their 8 to 9 million metric tons of beans they need for December, January as leverage towards that meeting at the end of the month. This chart shows us that higher basis in Brazil is showing us that they're running out of beans. So if China wants to buy some cheap beans, we have them, or the United States has them. So let's hope we can get something here at the end of the month.
Let's talk corn technicals. Corn futures, December futures held support at 410 with a corrective bounce higher. More concern about U.S. yields, especially owing to disease pressure. Initial resistance comes in at 4.3, followed by 4.49.
We've talked about this head and shoulders bottom formation. We're still trying to form the right shoulder, ceiling or neckline right around that 430. The 200-day moving average comes in at 438. This, despite the lack of USDA reports, corn is actually acting quite well. Again, another win this week despite the trade tensions and the lack of information as we held that 410 support. It's just a matter of time, but the latest we're hearing is AgWeb did a survey and the corn yield is coming in at 178.5. So the numbers, as the harvest progresses, the numbers keep coming in lower and lower. We keep consistently hearing that the yield is 10% below last year. That's 20 bushels per acre. We don't know if that's the final number. Is it 20 below the 179.3 or 20 below the high from the USDA August report at 188.8? Either way, I think we're finally breaking that 180, and we'll see how much lower it goes from here on in. But I think the later planted crops, both corn and beans, are suffering in terms of lower yields because of that dry finish. Don't forget to try our program. This week, we talked about the new 5-year bull market technical breakout in cattle futures. If you want to know where we think markets are going, sign up to the program. We talked about the 2026 cotton outlook. By the way, we have been a bull on cattle for 5 straight years. We've gotten this one spot on. We've never hedged it with puts or LRP. We just sold into the cash market. When you have a bull market like this that just wants to keep on going, you just sell into the cash market. Too many people have failed to make that a poor decision by trying to catch a top, both in the futures and whether that beef demand would peak at some point, and the markets have made them look pretty bad. So we're not going to get into why we think both are going to head higher. But check it out by signing up to the program.
News that China was willing to remove the tariffs on Canada if Canada would lift the 100% levies on Chinese EV vehicles has sent funds short covering in canola futures. Canadian and Chinese officials met today. They reportedly discussed broad agricultural issues as well as specific issues on canola and meat. They also discussed further working together in healthcare, energy, and environmental sectors, but there were no breakthroughs as yet.
If you're a speculator and you wanted to short canola, I wouldn't be wanting to short canola down here. The time to short canola was way up here in the 720, 740. It's not clear on the chart whether this is a bottom head and shoulders formation. It's very foggy, but it looks like it may be creating that with the neckline around that 619, 620. So I think the worst is behind us. I think canola is one of those commodities that's showing you that maybe we've factored in all the bearish news. And so again, I would not want to be short this market, because if we do get breaking headline news that we resolved this trade dispute with China, I think you're heading right back to that 650 or higher.
It's been a risk-off week in the broader market following from last Friday's sell-off. Stocks fell as the fear index increased on rising U.S.-Chinese trade tensions and bad regional U.S. loans. But investors were able to shake both off towards the latter part of the week. The Dow rose today as traders tried to move past the credit concerns that sparked a big sell-off in regional banks during the week. The positive sentiment has a lot to do with President Trump's comments about China. He supposedly is of the opinion that he understands the tariff threat posed was not sustainable and the 89 days pause could be extended. This acted as a tariff tailwind.
You can see from this chart that since World War II, you've had more bull markets that lasted much longer than the bear markets. So stay invested. Don't trade, just own and play the long game. The average bull market lasts for about 4.3 years. The average bear market, about 11 months. It takes 24 months for that bear market to recover. The average gain in a bull market is 149%. If you remember the start of the internet bubble in 1995, the NASDAQ was 1,000 points. Today, it's 25,000. When the NASDAQ doubles in 1 year to 50,000, maybe I'll agree that the AI bubble is about to burst. But until that happens, this AI cycle probably lasts for another 3 years. It's about a 6-year cycle. I think we're 2.5 to 3 years into it. And I think the bull market could last about another 2 years. But this AI cycle could help that bull market last longer than other bull markets, just because of the enthusiasm and the momentum behind a lot of the stocks in the industry.
While corn and soybean futures have more optimism behind it, wheat futures are still weighed down by big global wheat supplies, which remain a headwind. This is the December HRW Kansas wheat chart. It's bouncing near 480, but there's a fourth lower price count, which comes in at 377.
We've warned our clients that 50 cents lower could happen. That was your risk to 450, but this chart shows a final price count down in that 377. I hope we can avoid that. I think higher corn futures this week helped wheat carve out a slight gain to end the week, but I'm not sure we're out of the woods just yet.
Cattle futures continue to be on that bullish run. There's still no expansion really in sight. Trump announced that he'll be working his magic on lower U.S. beef prices. Trade says he is negotiating a possible deal with Argentina to import more beef.
So you can see on the chart here, we got this double bottom here, and then today we had that big sell-off because of that Trump headline news. The beef imports from Argentina might amount to maybe 20, 30 million metric tons. It's very front-end loaded, very small in the whole grand scheme of thing. I think it's nonsense. It's just noise. I expect cattle and feeder futures to recover into next week.
Crude oil futures continues to fall to its lowest since May after a surprise U.S. inventory build and confusion over India's Russian oil imports. The U.S. added 3.5 million barrels to storage, raising demand concerns, and OPEC Plus is still on course to raise their production.
It's early days. We've only started the winter, we're still into fall, but crude's already testing those April-May lows near that 56 and change. We did that today, so the risk is to the downside. I think we could break this next target at 53 and possibly go lower. This would be a great opportunity for the farmer to lock in some cheaper diesel fuel for 2026.
We spoke about this being a risk-off week. A big casualty of that risk-off trading has been Bitcoin. Bitcoin traded to new contract lows in times of safe haven investing, and more, you touched upon record highs in gold and silver. Bitcoin has shown that it is not a good risk diversifier like gold or the US dollar or the 10-year US bond yield.
Yeah, so you can see from this chart, your old support was 100,000. That's your new, old ceiling was 100,000. Now that's going to be your new support. Hopefully it can hold it. But again, this thing is well above the mean, which is the 200-day moving average, this red line on the chart. So at some point, and because we're bullish the stock market over the next 2 years, I think the U.S. Fed's going to lower rates by as much as 2 full percentage points between now and the end of next year. I'm not sure we're going to see this thing correct back down to that 200 moving average anytime soon. But, if you're looking to maybe buy into Bitcoin, we'd look towards that 80,000 again. 80 to 90,000 is maybe a buying opportunity. Until next week, thanks for watching, folks. Really appreciate it. Have a great weekend. Take care.
Bye, guys.